Topic 2 says tax strategies for new business. Tax strategies for new business, okay? And we have about five items to treat underneath it. The first one talks about organizational forms for business entities, corporate formation, partnership formation, single proprietor formation. The second one talks about basic tax consequences of entity choice. The third one talks about sale or lease of property to controlled entities. The fourth subtopic says other strategies for transferring property to controlled entities. While the fifth item says employee compensation strategies, where we are expected to discuss proprietor compensation, employee compensation, fringe benefits, deferred compensation, equity-based compensation, employee stock plans and options, partnership interest as payment for services. A look at these subtopics underneath this topic indicates that we are discussing the different types of business organizations that exist. That's in the A part. In the B part, we'll take the basic tax consequences of each form of business. In the C part, we are expected to discuss what happens when you sell or lease a property to a controlled entity. In the D part, we are expected to explore other strategies, methods for transferring property to controlled entities. While in the fifth part, we'll talk about how to compensate ourselves, either as employee, as employer, and the rest of them. Let's take the first item now. It says organizational forms for business entities, corporate formation, partnership formation, single proprietor formation. Organizational forms for business entities refer to the classification of business organization. That is, another word for organizational form is business organizations. Business organizations can come in any of the following ways. 1. Registered companies. 2. Partnerships. 3. Sole proprietorships. Let's now consider the three forms of businesses, one after the other. The first one, registered companies. There are two broad types of registered companies. The first one is limited by guarantee companies. Second one is limited liability companies. Let's take their definition. A company limited by guarantee is an organization registered with the Corporate Affairs Commission in which the liability of the members is limited to the amount they have all agreed to contribute to the company in the event of its liquidation. This means that the members have given a guarantee or pledge to provide stipulated sums as funds if the organization is liquidated. Let's explain what we mean by a limited by guarantee company. What this means is that if 2 or 3 individuals come together now to form a company limited by guarantee, what it means in effect is that if the company is liquidated after 2 or 3 months, the liability of the members is strictly tied to the amount they've volunteered to contribute. They are given a pledge to contribute if the company is liquidated. An example of a limited by guarantee company is the Lagos Chamber of Commerce and Industry. Lagos Chamber of Commerce and Industry. It is a company limited by guarantee. The next type of company is limited liability companies. A limited liability company is an organization where the liability of members is limited to the amount contributed to the organization's capital in form of shares bought. Let's take it again. A limited liability company is an organization where the liability of members is limited to the amount contributed to the organization's capital in form of shares bought. In this type of company, if a company is liquidated eventually, what the members would have lost is strictly tied to the amount they have contributed to the organization's capital in form of shares bought. Okay, this is different from a company that is limited by guarantee, where you have given a guarantee or a pledge to provide certain sum of money at the end of the company's liquidation. There are two types of limited liability companies: private limited liability company, and second one, public limited liability company. Let's take what we mean by a private limited liability company now. A private limited liability company has the following characteristics. 1. Membership ranges between 2 and 50. 2. There is no public subscription to its shares. 3. Transfer of shares to outsiders is prohibited. 4. The publication of annual financial statement is not required. Those are the 4 characteristics of private limited liability company. An example of a private limited liability company is Econet Wireless. Econet Wireless Nigeria. Econet. It is an example of a private limited liability company. Likewise, MTN too. Likewise, MTN. Even though they are big organizations, they are not public limited liability company. And this is because only 2 people is required to form the company, while the maximum number is 50. Okay? Then if you are a shareholder of a private limited liability company, you are not allowed to sell your shares to outsiders without first informing existing shareholders. And the other point is that even though they are a limited liability company, which is required to prepare annual statements, they need not publish those statements in newspapers. Those are the characteristics of private limited liability company. Let's now take the characteristics of public limited liability companies. 1. We are told that membership is not restricted. That is, minimum of 7 and no limit on maximum. That is, it can be as many as 1,000, it can be as many as 5,000. Number 2, public subscription to its shares is allowed. That is, once you are a shareholder and there's a need for you to dispose your shares, just approach your broker on the stock exchange and your shares will be sold without recourse to existing shareholders. Number 3 says the ease of transfer of its shares by members. This is tied to number 2. The 4th one says a distinct gap exists between the owners, that is shareholders, and those who manage it. Concept of legal personality. This number 4 talks about the fact that there is a legal personality on the company itself that is distinct, separate from those of its shareholders. The 5th one talks about there is a compelling need to publish its financials. This means that at the end of every operating year, you are required to prepare your financial statements. Not only prepare, you must publish it in at least 2 major national newspapers. While the 6th one talks about there is a legal requirement for directors to disclose their holdings in the company. This is a provision of the KAMA laws. An example of public limited liability company is First Bank of Nigeria PLC. First Bank, it is a PLC. Likewise, Bagger Paints PLC, it is a PLC company. Now let's take the next issue, which is the requirements for registration of a company, that is company information requirements. The CAC, that is Corporate Affairs Commission, is the statutory organ for the incorporation of companies in Nigeria. With an intent to register a business, the promoters will be required to furnish the CAC with the following documents: 1. Memorandum of Association. 2. Articles of Association. 3. List of directors and their addresses. 4. A statement of the share capital of the company. 5. A declaration that all the requirements for incorporation have been complied with. These are requirements that will be expected to be provided by the promoters of a business in Nigeria by the Corporate Affairs Commission. Now let's take the next issue, which is formation of a partnership. And we have defined a partnership as an association of two or more persons who are in business with a view to making profit. Again, a partnership is an association of two or more persons who are in business with a view to making profit. To set up a partnership, the minimum number allowed is 2. This is important, while the maximum number is 50. There are no stringent legal preconditions required for the formation of a partnership. A document called the partnership deed, this is important, a document called the partnership deed governs the relationship amongst the partners. We go on to say that there are 2 forms of partnership. 1. Ordinary partnership. Then 2. Limited partnership. Now let's define what we mean by ordinary partnership. The ordinary partnership exists when the partners agree to share profits and losses equally. This is very important. To share profits and losses equally. That is ordinary partnership. Each partner is regarded as an agent of the other. They are jointly liable for the firm's debts. That is an ordinary partnership. Let's take the second form of partnership, that is limited partnership. The limited partnership exists when a partner's liability is limited, this is very important, limited or restricted to the amount such a partner contributes to the business. The effect is that if the business fails, the debts will be shared in the proportion of their capital contribution. Let's pause at this moment and compare ordinary partnership with limited partnership. Ordinary partnership, we have been told, exists when the partners agree to share profit and losses equally, whereas in a limited partnership, it is said to exist when the partner's liability is limited or restricted to the amount that partner has contributed to the business. Let's move on now to types of partners. We have 3 types of partners. The first one is active partner. Second one is dormant partner, while the third one is nominal partner. Again, there are 3 types of partners. The first one, active partner. Second one, dormant partner, while the third one is nominal partner. Now let's take short notes on the active partner. We are told that the active partner is a partner who contributes to the firm's capital, okay? The active partner is a partner who contributes to the firm's capital and takes part in the day-to-day administration of the business, okay? The active partner is a partner who contributes to the firm's capital and takes part in the day-to-day administration of the business. This is very important for active partner. The second one talks about dormant partner. The dormant partner only contributes to the capital of the firm, but is not involved in its running. So now, the difference between active partner and dormant partner is that while both of them contribute to the capital of the firm, one is involved in its daily activities. That is the active partner, while the dormant partner is not involved in its daily activities. The third type of partner that we have is the nominal partner, and we have defined this as an individual who only allows his name to be associated with the business. This is very important. Who only allows his name to be associated with the business. It does not contribute to the capital, nor involved in its administration. The firm is only interested in leveraging on its goodwill. An example of a nominal partner can be seen perhaps when we have two young men fresh from the university who are lawyers, who are legal practitioners now, and perhaps they now bring in the name of a prominent lawyer. Let's use Femi Falana as an example now, as a partner in the firm. The idea is whoever says Femi Falana's name as a partner in that firm will be or might be interested in doing business with that firm, fully aware that Femi Falana, as it were, is a thoroughbred professional. So, a nominal partner is not involved in the daily activities of the firm. Neither does he contribute to the firm's capital. What the firm only wants to do is to use its goodwill to attract business to itself in the industry. That is all we need to know under partnership formation. Now let's go to the third type of business enterprise. That is the sole proprietor. Sole proprietor. Okay? This is otherwise called sole trader. More often than not, sole traders are unincorporated businesses. The key word here says more often than not. That means that in some instances they could be incorporated with the CAC. They are owned, managed, and operated by one person. An example of sole traders